Hello and welcome to Investing from the Scratch. In this video and in the next videos I will publish on the same subject, I will share with you all the things I learned and that I wish I knew when I started investing 25 years ago. And this video is dedicated to all those who are thinking about investing, but they don't know where to start. They have no clue what it's all about. So the intention here is to help them out in the best way I can by sharing what I know. So this is part one, the first video. And in this first video, we are going to talk about one of the most important subjects that are for beginners, particularly for people who have never done anything like this before, never invested, never traded, never touched anything that relates to it. And we are going to talk about the character and personality of a successful trader or investor. So why another video about investing? There are millions out there. There are millions of books, millions of articles. Everything has already been published on the subject in a way or another. So this video is not going to tell you anything that somebody else didn't already talk about in the vast amount of information out there. The reason why I publish these videos is because I want to give you an understanding from the scratch and try to organize my experiences and the knowledge I have in a way that a beginner investor can follow step by step on the way forward. Starting very, very simple, describing a number of elements that are important to know for any investor before actually getting into the technicalities of the thing. So I want to give it a format that can be used by somebody who knows absolutely nothing about it. The other reason why I'm doing this is that a part of the information out there, particularly on social media, is not always unbiased information, if we want to put it in this way. So to put it bluntly, a lot of people want to sell you stuff when they're trading, when they're explaining how to trade. They want to sell you a training course, they want to sell you a software, they want to sell you an idea. They are not unbiased. They are not telling you what you need to start investing. They tell you what you need to know to buy what they offer. And particularly, you have these videos about people with jets, people with Ferraris, and all this kind of stuff. Now, this video has no commercial nature. I'm not trying to sell you anything. I'm not trying to sell you any product. I'm not trying to sell you this video. It is completely for free for you. And I will not try to sell you even my ideas. I just share my experiences. All right, before we go further, I must clarify a few things which I think are very important. The first thing is obviously, it is almost obligatory to mention this video, this material is for information purposes only, exclusively. It is not an invitation to trade, it's not an invitation to buy stuff, it's not financial advice in any way, shape or form. It's just my opinions and I share them with you as such. I don't try to teach you anything. I don't try to present my ideas as the truth as everybody knows it or everybody agrees on. It's just an opinion sharing, it's just experience and knowledge sharing. That's it, just for information purposes. The other thing that I would like to mention is just to clarify who I am. Okay, so I told you I have been investing for quite some time, 25 years, more or less, give or take. I've always been a retail investor, means I always invested my own money. So I never worked for an investment fund or a pension fund. I never been a broker. I have never been on the floor of the New York Stock Exchange or this kind of stuff. So I never worked in a professional fashion as an investor. Unfortunately, I don't have a yacht or an airplane or a Lambo. I never bought any of these things. What I can tell you is that after so many years, I collected a lot of experiences which I think can be useful for others. I studied a lot and I read a lot, and I formed an opinion about a number of things that I would like to share with you. You can call this food for thought more than anything else. Just something that you should consider in the process of deciding if you want to start an investing career. I did survive a number of very difficult times, and we are talking about the year 2000, for instance, the financial crisis. We are talking about a number of other small disasters that occurred in the last 25 years. If you look back in history, you will find them. I saw them more or less all, and I lived through all those moments while being an investor. And I survived them, and I learned a lot of things during this process. I made an incredible large number of mistakes. I guess I'm still making some of them, but I'm working on it. So again, I am not qualified to teach you anything. I am just qualified enough to share what I learned and hopefully to give you something to think about, and nothing else than that. But what is investing that we're talking about here? Because there are many ways people understand the word investing. One of the best ways I know is investing in yourself, investing in your career, investing in your family. But we are not talking about those kind of investment. We are talking about investing as a form of creating wealth by putting money to work. Okay, so this is financial economic investing for the purpose of making money. That's what we are talking about. There are also a lot of discussions about the difference between traders and investors. Short-term traders, long-term investors, all this kind of stuff. I will use investing and trading almost in the same sentence without any problem, because I feel that everybody who is investing or who starts the first investment must perform a trade, so is a trader. And everybody who is trading tries to generate wealth, thereby is an investor. The only difference I know, and it is a material difference between one way of trading and another way of trading, is represented by the tools used preferably by these different kind of investors. So some investors prefer to use technical analysis, means charts, indicator, and this kind of things, this kind of approach. And another group of investors prefer to look at the fundamentals of companies, like the balance sheet, the cash flow, the financial statements in general. But from the perspective of this video, there is no difference between the two, because I will share with you information that are potentially important for both. The first thing you have to understand when you are talking about investing or trading is that it is a business. Okay? So from that perspective, there is a lot of advertising going on the internet and elsewhere, proposing the notion that everybody can become an investor, which is true because, you know, it is very accessible to start a brokerage account and to deposit some money and to start doing things. But there is a very big difference between being an investor and being a successful investor. So much that when you're looking at trading platforms, for instance, they're obliged by law to tell how many people are losing money while using their platform. And the percentages are scary. We're talking about 70%, 80%, and even more. And it is out there. I mean, they are obliged to do so, and they publish this information. If you think about it, that means that 2 in 10 persons trying to invest are having success in doing that. And one of the reasons I think is that many persons starting investing should not start at all. They don't have, for various reasons, they don't have the right characteristics to become successful investors. And investing is digital. Either you make money or you lose money. There is no real way in between. Eventually, a successful investor will start to make money consistently, whereby a non-successful investor will start to lose money consistently. There are two sides of this medal. So what is a successful investor depends on basically two aspects, which I would like to focus on. The first aspect is the character and personality of a person who has the best chance to become successful in investing. This is about this video. Okay, we are going to talk about this, character and personality, part 1. In the next video I intend to publish, we will talk about another set of characteristics, which are more related to the haves. So, for instance, knowledge, skills, experience, money, time, and all these kind of things. We're not going to touch on this subject this time. We are just going to try to describe those traits, the B of a person, how the person is built, how a person ticks, that represent a success or failure chance for somebody who wants to begin. I thought about arranging this number of personality traits and characteristic traits in a kind of interview. Okay, so kind of I ask questions to you and try to get an answer in order to identify those traits that are more conducive to a successful investing career. And the first one is, are you emotional? Now, this is one of the most widely known characteristics that practically everybody agrees on. Being an emotional person versus a rational person, so you have to see these two in opposition to each other. Being mostly emotional person will play a major role in defeating you in your investing career. We will see later why, and in particularly what aspect of emotional reaction and emotional thinking, if you want, plays a major role. But if you recognize yourself as an emotional person who tends to think in feelings more than in knowing, who thinks more irrationally than rationally, then bad news, because this is going to be a real problem for you. Together with the thinking in terms of feeling, instead of being rational, there is the reaction to events. So the impulsivity, the doing things without thinking about it. A lot of people fall in these two broad categories. And it is really a character trait. You know, it's not something that you can change very much. After a person reaches a certain age, character and personality are formed, and this group of people will tend naturally to react to events in a certain way and to think about things in a certain way. The other thing that a lot of people share, also in the same group, is being easily impressed by things. Now, it is true, part of being easily impressed derives also from experience. A person who has seen it all, done it all, reached a certain age, is supposed to react less impulsively and being less impressed by things taking place around them. But my experience and my observation is that a lot of people who are easily impressed continue to be easily impressed. Doesn't matter how many experiences they have seen and how many things they've tried, every time something happens, they get impressed. And they get impressed always in the same way. So it is true that experience plays a role, but it doesn't explain it all. There is really a personality trait that describes the ease of impressionability, if you want, of a certain person. And together with that, we have the cosmetically oriented people. I call them in this way. These are people who are keen on beautiful, on looking good, on things that appears appealing and desirable. And it is all about the looks, or mostly about the looks. Let's put it in this way. Now, also for this kind of people, and this is also a character trait, bad news because A, investing has very little beautiful about it. And secondly, there is a lot of stuff out there which is meant to look good and to impress people in somehow, but which is not really reliable. So if you are choosing a car because it has a nice color or because it has nice interior, instead of looking at the technical specification of the car and to think hard and long if you want to spend money on that kind of thing before you buy it, investing is going to be a sea of bad experiences. Very briefly, we are saying that being an emotional person, reacting impulsively, being attracted by beautiful and a few other things are not traits that are recommended for investors when they start, especially when they start, beginners. But there are other aspects which are really playing against a successful investing career. And these are the more intellectual aspects of personality and character. The lack of curiosity is one of the most important aspects that play against investors. Beginning investors, somebody who wants to start in this activity, in this world, without curiosity, it will be extremely hard to even get started because the world of investing requires a lot of research, a lot of analysis, and a lot of looking at new things and trying to understand them. And people who are not curious by nature will find it very, very difficult and extremely boring. So lack of curiosity is one. If you dislike reading and studying, it will be almost impossible for you to begin, simply because even if you go for the easiest way of approaching investing, which is, you buy something for all your life, you put your money there, you forget about it, and it is going to become your pension, you still need to know what you're doing before you do it. And if you don't read at least the basics around what your investment plan is, you will never be able to succeed. You are at risk of making very, very large mistakes. The same applies to studying, because in any way, shape or form, when you invest your money, you have to know what happens if certain things take place. For instance, if you go for a long-term investment all your life long, you need to understand there are, for instance, taxes implications. You need to study what happens if you take your money out of your investment before a certain time is reached, and a number of other things. So without studying and reading, you will start with a very disadvantageous position when you try investing, because you basically start by saying, I don't want to know anything about it, I just want to put my money somewhere and I hope it will grow. Investing doesn't work in that way. Learning is fundamental. It goes with studying and reading, but learning is really understanding how things work in specific details to let you decide what is the right way you want to approach this. And there are a lot of people who don't like learning. They don't like reading or studying. And we know that a fair amount of people would much prefer to do anything else than sitting down, reading something, learning how it works. They are just disliking it completely. And this is very bad for somebody who enters in a world which is actually based, at least in part, on knowledge. Because being a successful investor means knowing something that other people don't. That's a part of your advantage. That's a part of your success chances. Knowledge. And without reading, studying, and learning, knowledge cannot be acquired. So you start in a very, very weak position. And the last, but not least important aspect that we need to discuss in this category is, if you don't like to think, really thinking, it is going to be as well extremely hard. And on this one, you can roughly divide people into broad categories. You have the thinkers and you have the doers. Now, the thinkers are those who reflect on things. They have self-introspection. They ask a lot of questions. They want to find an answer. They think about the answer. They put it into discussion. They think about it again, and so on and so on and so on. And then you have, again, very general terms, the doers, people who prefer to think about things as little as possible, and they just go for it. This is not the same as being impulsive, not necessarily so, but simply put, people who like to be active in doing something instead of thinking about doing something. This is the big differentiation between these two groups. And being a doer in investing is not a good trait for the simple reason that most of the investing activity is based on the characteristics we saw before, but also about thinking on what a person has learned, what a person has seen, read, have heard about. Without thinking about it is just a question of basically guessing on things. For a large number of people, there is another element that plays a major role, which is this one. A lot of people hate numbers. They don't like numbers, they don't trust numbers, they don't want to have anything to do with them. If they can avoid it, they would stay out of it. Now, good news here, the investing world is all about numbers. It's based on numbers. Numbers are the language of investing. So if you hate numbers, it's going to be tough, particularly if you can't understand something as simple as this. I'm sorry, it was a joke. It is not true. So I'm using this little trick to get you to understand what numbers are we talking about in investing. The example you see on video is about investing, but you don't know to have the knowledge to understand this formula at all. The numbers in investing, while it is its language, it's also made of rather simple numbers, like this one. This is a typical case, this is a typical example of a ratio, for instance, which is used in fundamental analysis, which is extremely simple to understand. So, from the complexity viewpoint, the numbers are essential, but they are not complicated. And you have to put this into relation to the fact that a lot of people try to convince you about the contrary, that investing is very, very difficult because there are a lot of complicated numbers, things you have to calculate yourself. You need a PhD in mathematics just to start. It is not true. Numbers are simple, but you have to know the numbers and you have to understand what they tell you, okay? But if you have a resistance to numbers in general, there are very few options you can choose from if you want to start investing, whereby if you can live with some basic arithmetics, you will have many more options. But on this one, just remember, however you want to cut and slice it, even if you go for the technical side of things, or if you go for the long-term, once-in-a-lifetime investment for pension fund and this kind of stuff, if you hate numbers, you will be basically starting with no idea what you're doing, because it's all about numbers. Since we're talking about numbers, I need to share with you another little dirty secret, typical of investing world, where numbers seems to be a given. 1 plus 1 is always 2. Well, that's what we learned in class. That's what our teachers told us. That's what a lot of people believe is the case at all times. But the investing world is very peculiar about numbers because it's a language, remember, and everything is based on that. But as often happens with languages, there are nuances, there are dialects, there are things that could mean two different things, same word, two different things. With investing, numbers are playing that role. So 1 plus 1 is not always 2 in investing. And when we say, okay, maybe it's not 2, but it is probably 2, depends. Sometimes it works that way, and very often it doesn't work that way. Fact is that when you read the number in the investing world, in the investing activity, and you assume that number could mean what it is meant to mean, you must put that into question all the times, okay? Because we are not sure at any point in time what the one actually means in the investing world. Okay, you could now say, okay, this makes no sense. How is it possible 1 plus 1 doesn't make 2? Well, I'll tell you. I will give you an example, and I will make a story out of it, but just to get you to think and also be warned about one of the main characteristics of investing, which is numbers are used to inform, but they are not always what they seem to be. So in investing, my rule of thumb, personally, is this one. 1 plus 1 is always banana, or almost always. And what I mean with that? I mean with that elements that are understood and they are standardized, like the value 1, okay, and something that is understood and clear as a plus, as an addition, and another element which is the same as the previous one, which is another one, okay, should come out with a granted result. But the thing is, very often, the first one, could be something else, could be one elephant, for instance, okay? I'm making a joke here, but think about these kind of things. One elephant. And then you have the plus, which is an addition, supposedly, but could be something else. Could be a butterfly or a lake. And the second one, which is supposed to be another elephant, could be a tiger, or could be, a smartwatch, or could be anything else. So when you are in the investing world, take into account that appearances betrays, also with numbers. And particularly with numbers, because numbers are used everywhere, as we saw it before, but the value of that number, the understanding of that number, and the understanding of a plus or a divided sign or whatever else you can think about, requires you not only to study what they should mean, but also being extremely careful when they take a conclusion out of those numbers. And that's why we were talking about before the curiosity and the learning process and the learning ability of a person. Because if you go by the simple, most obvious result you can think about, also with numbers, you will figure out very, very quickly that one doesn't mean necessarily that the next one is the same, or they mean one anyway. It is a bit advanced as a concept, but I want to explain or to present this as my experience, because I saw this a lot of times, things that are obvious are not obvious at all. There is very often something hidden. There is also some things that are not there which are important. So take this into account. Okay, let's leave the numbers and the jokes on the side for just a second or two, and let's talk about something else. We all know the personality trait that is allergic to changes and even more allergic to surprises, particularly changes. You might have come across the terms resistance to change, which is extremely frequent in people. I mean, if you have a job and you want to do something new at your job, you want to do something new with your friends, you want to change something at home, you will find very quickly that a lot of people kind of prefer to leave things as they are. This is a personality trait. Change is, for many, many people, unwelcome. And changes by surprise, so not knowing that a change will take place, is for a vast majority of people a big no-no. Now, on this one, you must realize that the investing world is changing by the second. By the second. Just look at the share price changing on a trading platform or whatever you care to look at. They will change many, many times per second. There will be an incredible flow of information coming to everybody, and particularly to somebody who invests, and every single piece of information, every single happening is a change, and sometimes it's a big change. And most of the time, these changes are not announced. They're coming by surprise. Which means that if you like the feeling of control, like you think that you are actually on top of things, because of the amount of changes, the amount of surprises you will be facing, you must realize you will never be in control of anything at all. It's going to be very much like relinquishing control of everything that happens around you and keeping control of very few elements as an investor, things you can do and things you can change by yourself. But 90% of the investing activity is a kind of tornado going around you and changing the things you have, changing the way you think, changing the information you had yesterday and giving them a completely different twist. Millions of examples about it. But if you don't like changes and you like to feel in control, you won't have any of these two. Which means that your level of predictability for tomorrow is pretty much zero. You won't be able to predict anything. 90% of what will happen tomorrow is something that you might imagine, you might assign a certain probability that those things will happen, should happen, could happen. But if you want to make sure that something happens in the investing world and you want to be able to predict what will happen tomorrow or in 1 month or in 1 year, it doesn't matter. You won't get there ever because there is no predictability. It is an extremely chaotic situation. And similar to the other ones, if you like certainty, so for instance, if you like to know that at the end of the month you will have your paycheck, $1,000, $2,000, whatever that paycheck might be, and you want to be sure that the paycheck arrives, and you want to be able to count on it, nothing like this in investing. Certainty is not available. It's simply not there. So your results in investing will change all the time. Sometimes you will have a good period. Some other time it will be a disaster. Some years you will make money, some months you will lose money. So there is nothing certain while you invest. Everything changes, nothing certain, there is no control. And on top of that, if you hate taking risks, I have very bad news for you, because if you think about investing, you must think it is 100% risk, 100%. So while with numbers we saw investing talks numbers are their language. For risk, investing is equal to risk, one-to-one relationship, and there is no way in the world you will be able to have a completely risk-free investing activity. There will always be something that can go wrong. So, and all these are really traits that some people have, many people have, and they're fine for certain things, but they would find investing really challenging, because they will feel really scared or worried most of the time, simply because they don't have any control, and they don't know what will happen tomorrow, and all what they are doing, what they are not doing, represent a risk, all of it. Now there are some movies and there are some elements that suggest investing is a rather orderly, organized activity, full of computers, full of rules, full of things that appears orderly. But investing is not orderly at all. Investing is, as we saw before, based on continuous changes, continuous surprises, things that are fairly unreliable, and so it feels like madness. Madness in the sense that because of this uncertainty, unreliability, and ever-changing situation, the world of investing is really looking and feeling very much like being in, a place where people do things that makes no sense, and things are happening that makes no sense, and information comes in that also makes no sense, and it is completely unreliable, and it is always changing. Is a madhouse. Okay, so if you think about investing, think about getting into a madhouse in full action, where nothing really can be understood at face value, and things happen that are unexpected, and they are doing that all the times, every second. Together with that, and especially in investing, you will face situations that make no logical sense whatsoever. And we are talking about a million of possible things here. We are talking about, for instance, companies that you might be invested in, for instance, or you read about, doing things which are absolutely crazy. That makes no sense whatsoever. You think about it again, you look at the numbers, it doesn't make any sense. It's complete nonsense. You read information about this company, or you read information about what is going on in the world, something that you have to do as an investor if you want to, not anticipating necessarily, but at least to try to understand what kind of situation is going on at any particular time. And you read things about, what people do, what people say, or things taking place, which are complete nonsense. No logical explanation for them. Nothing at all. Or they have a logical explanation of them, but you don't have that logic, which is also possible. But investing is facing continuously both madness in terms of chaos, in terms of unexpected things, and also nonsense, things that have no logic, no rationale, you can't explain them. Also because the world of investing is so chaotic, so ever-changing, so full of irrational things, often enough, very often enough, you will experience waves of panic, sheer panic, going on everywhere. And you see it, well, you see it quite often in newspaper because they go saying the index so-and-so went down 300 points yesterday and investors are scared and this and that. This is a wave of panic. And waves of panic, as I said before, are quite frequent, and you will face them as an investor regularly. If it is not about that specific company, it's about the whole market. If it's not about the whole market, it's the government, or is the expert saying that the world will finish tomorrow. You name it. There will be plenty of it. And opposed to that, there are also waves of irrational exuberance. Somebody called it in that way, which is also funny because it's the opposite. So where everybody gets excited and everybody thinks that is the best that can happen and that it cannot go wrong anymore, and all this wave of optimism that leads people to do also quite stupid things. But both these elements are present in the stock market, are present in investing activity anyway, many, many times, sometimes multiple times a day. You have, particularly when certain information is coming out, you will see it under your eyes. What happens? Just waves of panic and waves of over-enthusiasm about things. And then chaos. Chaos in this particular case means that the elements that make the investing activity, the elements that moves company, the elements that are present, that have an influence on what you're actually trying to do, are extremely chaotic. They change direction for no particular reason. Sometimes they stop. Sometimes they collide. They move all around you in ways that cannot be predicted, as we said before. So it is extremely chaotic, very difficult to follow single elements, and extremely difficult to follow more than one or two elements at the same time. So you have to be able, you have to have the character and personality where you don't get too affected by these situations. Because if you get nervous while you are when you are entering the madhouse, and you get scared when the panic wave takes place, so the chaotic moments that you will experience every day, where it is not really clear even what is taking place, if you can't cope with this, you will have enormous troubles. And there is a fair chance that all these elements will lead you to make very bad mistakes. Modern society, and particularly in the last, I would say 40 years maybe, we experienced a phenomenon that is quite interesting. We lost the notion of time and the notion of waiting. So basically everybody expects certain things to happen more or less instantly. We flick a switch and we get light. We open a tap and we get hot water. We turn a key and the car starts. And it has to happen now. We expect it to happen now. Technological advancement has made this possible in many areas. But for investing, this is not the case yet. Investing is waiting. So when somebody approaches this activity and is able and willing to wait as long as it takes, that's a very good thing. But a number of new investors are not in that position. They are impatient. They are impatient as they expect, or they hope, or they wish, or they feel entitled to things to happen really, really quickly as possible, possibly yesterday. There are also a number of people who are constantly in a rush. Doesn't matter what is going on. And if you try to get these people to sit down and relax, open a book and do nothing for a while, you will not succeed. They are always moving. They are always rushing around, doing this, doing that. They can't stop. In investing, this is a very, very bad habit, because the more you do in investing, strange enough, oftentimes the less results you get. And that depends, partially at least, on the fact that some people expect or hope to become rich very, very quickly. Don't count on it. Don't count on it at all. Becoming rich and staying rich, because that's the other story, becoming rich very, very quickly could be a strike of luck, but staying rich for long enough, it's a challenge in itself, and it is dependent on time. Everything is dependent on time. Companies need time to become bigger and stronger. Whatever kind of investment you want to make in that field is automatically related to time, as well as to other things. Impatient people, people in a rush, people who want to get rich tomorrow, and they act accordingly in their investing activity, are going to have an extremely hard time. And this kind of specific people will almost certainly make some terribly bad mistakes. Now we are going to touch on a very controversial subject, which is the value of information in investing. There is a fairly large amount of people around who tend to believe that what they read, or what they are told, is true at more or less face value. And they believe it. They trust the source, or they trust the information, and they take it as it is. And they act according to what they hear or what they read, what they are told. Now, this is particularly important for investors because if you think about it, what causes investment to go up and down? What causes the market to move every day, every second? What causes a good companies to become bad? What causes a successful versus not successful investors? Is the way that information is published, is put forward, is used, is understood, and it is perceived as valid. Now, I've been investing for a very long time, and I like to get all the information I can every time I can. I'm extremely curious, and I'm reading a lot. And I can tell you that, in my experience, at least 80% of the information that is around is partially incorrect, partially biased, mostly useless, strange enough if you think about it, but that's what I experienced, and unreliable, in general unreliable. What happens is that when you read sufficient amount of information on a daily basis, you will realize there are a few categories of information. There are information that is something that actually happened, like an earthquake, or a natural event, or a social event, something that is material. You have images of it taking place, you have videos of it taking place. So it's real, it did happen. Then you have another category that is opinions, and that's the largest part of information that is getting published on a daily basis. Opinions. And the reason why so many opinions are published is because newspapers, whatever media they are using, internet, newspaper on paper, still existing, I heard, they need to fill the news with something. And if nothing takes place, they use opinions of others. They get interviewed, and these guys say what they think is going to happen, or what has happened, or whatever else. They're all opinions. And there are millions of these opinions going around. And these opinions sometimes move markets, move the price of assets, reset the expectation of the market, increase the level of fear, or increase the level of enthusiasm, but they move. They move a lot. From an investing viewpoint, whatever kind of investing approach you are thinking of, you must be able to deal with information in a very special way. You have to use what is called critical thinking. You have to be able to take a piece of information and ask yourself a number of questions. First of all, is it true? A lot of information is false. Stuff that people say did happen, it didn't happen. A number of information is incorrect and is incomplete because they say A, but they don't say B, C, and D, which is also important to mention. They don't say that. A part of information is biased. It is published for a reason. We know that information is used in certain cases to influence the behavior of people. And that happened, and it will happen in the future, no doubt about it. But if you don't ask yourself, where is this information coming from? How reliable is it? And then, after all, does it matter for me? Is it going to change anything in what I'm doing as an investor? You will have a very hard time, because then you have two choices. Either you ignore all information because you take the view that either it is irrelevant or it is not correct in some ways, or you read everything and you act according to everything, which means that tomorrow somebody will come out saying that the end of the world is near, and you will sell everything you have. And the day after tomorrow, somebody else will come out saying that there is no evidence that the world will end tomorrow, and you will buy it back. So you will be moved by information that is continuously contradicting each other from day to day, from hour to hour, sometimes from minute to minute. So with information, you have to have very specific skills, very specific character, actually, because it's a character trait. Critical thinking, and we are going back to the part that we saw a couple of slides back, you know, the ability and the willingness to think things through. Critical thinking is questioning things, putting doubts around it, double checking them, and eventually discounting or ignoring a very large number of them after you assess them. People who do not have this natural ability to collect information, take out everything that is making no sense, or it is there is no evidence, let's put it in this way, it is true. All the opinions of all the experts, all the professors, very large part of other areas of the society where people love to share their opinion about everything and they keep changing their mind every day. If you cannot discount all this information in a rational way, and you start to believe that any of this is true at face value, you will end up constantly changing your investing approach, your investment choices, and making a lot of mistakes in the process. So, and this is something that is part in the character of somebody. People who tend to trust others, people who tend to trust authorities or experts. And this is something that other people don't do. Just don't do because they don't have that trust in themselves. They always question everything. Critical thinking, and on the other side, skepticism. Skepticism is, how can I explain it, is putting in doubt or in question something that everybody thinks is true. A skeptic is also a person who asks questions. He's also a person who doesn't believe everything he's told, and he probably will try to figure out other explanation for certain things. Dealing with information in the right way represents a huge advantage for those who have this ability, because the market gets moved by things, interviews, events, disasters, whatever you may think about it. And what happens very often is that the market assumes that certain events will impact certain areas of the economy, for instance, or certain companies. And it's a continuous reevaluation of these assumptions that move markets, to an extent at least. If an investor has the ability to question how an event taking place on the other face of the earth, completely unrelated to any company he is investing at the moment, or he questions the fact that whatever happened will have an impact further than 1 week from now, and come to a logical conclusion that all these big market movements are completely motivated, the sky is the limit there, because the advantage of such a person is that he would stay the course, for instance, whereby the market experienced one of the panic waves we have just finished talking about a couple of slides ago. But if this skill set, this mentality is absent or is insufficient, it is going to be very hard to collect information, and it will be very hard to evaluate information in a way that is actually helpful. Now, this is very typical of beginner investors. Typically people who are relatively young, enthusiastic, and they see investing as an adventure. And investing is an adventure, definitely, and it is extremely exciting and can be a lot of fun. But it is a specific kind of fun and a specific kind of excitement, what we're talking about, and depends very much on the expectation on the individual. So, for instance, people who are looking for fun, they think or they imagine, and I saw that very, very often, that investing is a very dynamic activity. And it can be. You know, certain areas of investing are quite dynamic. People who are busy with day trading, for instance, are always busy with that, and 24 hours a day, as long as the markets are open. And people in general who are busy with technical analysis, looking at graphs, charts, indicators, and this kind of stuff, there is a lot of fun to be found there because it is very interesting and it is very dynamic. It moves a lot. It can also be extremely exciting because, again, for these kind of investors, the technical investors, I call them, they will have always something to do. And they will always tend to react or try to anticipate things before they happen, which is exciting. So a lot of action as well. Selling, buying, selling, holding, deciding, changing your mind. The graph says this, indicator says that, and so on and so on and so on. And a lot of adrenaline. This is what you see in certain movies about trading. You see all this crazy action taking place, and you see all this shouting and people running around and all these kind of things. But you have to be very careful as an investor on the amount of fun and excitement you can get and what that leads to. So one particular thing that happens a lot is that people, when they are approaching the technical side of things, they tend to overtrade. So they make far more trades than what is advisable to do. And together with that, they increase their costs and they increase their chance of making mistakes. This goes a bit together with the approach of many people with time. They can't wait. They need action. They need to do stuff. In my experience, and I know there will be people who disagree with me, but in my experience, those who prefer the action and the fun and excitement to the more waiting approach are more at risk of making mistakes. For one, because they can't wait to do things. For the other, because they get so excited about certain things that they don't think too much about it, become impulsive. For the third is that all this action is actually doing and undoing things continuously, selling and buying continuously, hoping to make a profit out of the majority of these activities. Particularly at the beginning, and particularly when the necessary knowledge on how certain things work is present and it is strong enough, looking for fun and action leads invariably to making a lot of mistakes, but really a lot, and very costly too. Okay, so a lot of people at the beginning is attracted to technical trading because it is apparently easier to do than fundamental trading. It's not particularly true, by the way, but just leave it as it is. And they start with that, and they want to have the adrenaline. They want to be the actors in a film like they saw on TV or the movies. It's all good and dandy, but realize that whatever you do and whatever kind of action and adrenaline you are seeking, there is a risk connected to looking for those things, a very big risk. And that risk is subtle in the sense that it creeps. It doesn't, hopefully, it doesn't come in a big bang, but it's something that actually lose people's money rather slowly, but rather consistently. If you're looking for that kind of fun, you have to consider really, really closely the possibility to start very small, and very careful. And soon you will realize that all this fun and the excitement is more a movie fiction than anything else. Even when people spend hours and hours and hours looking at graphs and indicators and reacting to events and information and opinions published, and they're always active in this world, after a while the fun becomes a lot smaller. And the excitement becomes a kind of habit, it becomes a kind of routine. At the end of the day, every investor I knew and every investor I read about come to the conclusion that investing, after a while at least, becomes quite boring, because it becomes either a question of doing things that have been done already thousands of times, become kind of muscle memory if you want, or those who prefer another investing approach, which is more on the fundamental basis, they come to the conclusion that actually there is nothing to do else than mostly waiting. But be very careful with the fun stuff. Be very careful with the excitement and the adrenaline, because those are the drivers for most new investors, particularly technical investors, to lose a lot of money and to lose them really quick. Now I want to go back to being a bit provocative, and the reason why I do this is really to get you to think and to evaluate what your opinion, what your expectations are, what you think you can be good at or you can become good at. And the question is, do you like money? Now, most investors will tell you, absolutely, that's why I invest, because I like money, because I want to make money, because I want to become rich. Now, beginner investors, in particular, are starting with this exactly for this purpose. Apart from the fact that many of them expect to become very rich very quickly, and they expect to become very rich very quickly using tools they don't necessarily understand very well, there is something that is very interesting I noticed in a lot of cases. A lot of people say they like money, right? But as soon, most of them, as soon as they have the money, you know what they do? They give it away. They buy the yacht, or they buy the airplane, or the Ferrari. And then they make a video about how lucky and how good they are. A lot of people hate money. They hate money in the sense that they don't want to have the money as such. They want to have the stuff they can buy with the money. They want to have the fun, the freedom, and the independence they expect from having money by buying stuff. So, when you are a beginning investor, you have to ask yourself, how much do you like having money as such? Not all the stuff you can buy with it, because that's not the point. The point is that you must get into the thinking of I make $1,000 in profit. What do? Do I buy a new color TV? Well, your investing career is already taking a dive because you are not reinvesting what you earned. So you will never grow. You will always stay where you are. Also, people who actually like to buy stuff more than having money to use to create other money will very quickly come to dislike the investing activity because it looks like an activity in itself. The result of getting money to work is to get more money to work with, not to buy stuff with it. That's not the point, especially at the beginning. After you make your first $1 million, you could also decide to do something else with the money you put together. But a successful investor is somebody who consistently achieves results. The more money you have available for investing, the bigger the chance is you will be successful. In order to achieve that, you have to retain the profit you're making and reinvest them. If you start to give money away, you will not get there. This happens a lot, really a lot. I know and I read about a huge amount of investors who have been successful, especially at a certain moment in their life. And then they took all the money of a large portion of it and they just spent it. Spent it in something that produced nothing. And it doesn't represent an investment. Now, guess what? After a while, all the success story they started with evaporated and they became far less than wealthy. There are stories all around about people who decided, particularly in the sports sector, people who decided to invest in something and they start to get crazy ideas about where to invest in and they get in ventures that are extremely risky. Before they know it, it's all gone. So on this score, you must be very careful and very honest with yourself. If you are the kind of person who prefers to spend the money to get the goods or the services they like, and they prefer to have an empty bank account and a very large color TV in the living, investing is probably not for you. Because investing is really about consistently reinvesting money and to have a keen appreciation for having money as such. That's one of the main characteristics of good investors. They like money as such. So this is not a complete list of all the characteristics and all the personality traits a person might or might not have that are conducive to become a good investor. This is just, just the first big item list that I could come with. The most frequently found traits that some people have, and the most important traits, in my opinion, that are suggesting in the beginning good chances or bad chances to become a profitable investor. Now, if you found yourself in any of the categories we described and say, yeah, in fact, I'm a bit emotional, or yeah, I don't have a good relation with money, or I can't wait, or I don't like reading, all these kind of things. Now, think twice before you start. Because you remember at the beginning, we were talking about the statistics about people lose money. 70%, 80%, and more. There is a reason for that, and a very clear reason for that. Most of people who try investing are not fit for that kind of activity. They're simply not fit. That's the reality of things, and I cannot think about anything else. Statistics, what was the proverb? Lies, bloody lies, and statistics. Well, those statistics are probably correct because they are going against the interest of people who publish them. So I tend to believe that those numbers are relatively accurate. But even then, this is the vast majority of people losing money. Vast majority. Which is very strange in a way because, investing however you want to do it, it's not particularly complicated. It's not difficult to make money however you want to do it, with a few exceptions which are extremely risky. But in general terms, if you wait long enough, or if you're good enough, you can become a successful investor if you do have certain personality and character traits to start with. My personal conclusions are that most people, as I said before, are not fit for becoming investors. They're not fit for sitting in front of the chart. They're not fit for selecting the right stocks. They are not fit for taking the right decisions, even when they would decide to create an investment fund. They don't know what they're doing. They don't want to know what they're doing. They will eventually follow somebody else telling them what to do. They will not follow it. They will not care for it, and they will probably get themselves a number of very nasty surprises. Good investors are very specific people. They have certain characteristics which are quite rare. Most of people do not fit in that number. That explains the statistics. It's not a question of luck. It's a question of having the right stuff. Now, I don't want to discourage anybody from trying. I just want to warn people before they start on the importance of certain characteristics. And truth be said, even if a person has certain characteristics that are really a minus for a successful investing career, they can still train themselves. They can still try to change the way they behave. Okay? But if you start with something that is really a big minus, and you're trying to train yourself in being more patient, you try to train yourself in loving reading while you actually hate it, you try to train yourself in being less impulsive and being more rational, that will be a lot of work, because you are trying to reverse engineering the way you have been formed at whatever age you have, and that will be really a hard job. On top of that, my finding is that even those who decide to keep going and decide to get trained, decide to follow courses and whatever else, just a few of them actually become as successful as they would be if they were having the right stuff. And it takes them an incredibly long amount of time, a lot of effort, and also a lot of money. So the question is, eventually, if you compare like for like the things you can do in your life to become wealthy, investing is just one of the ways existing. You can become a fantastic professional in your field if you want to, or you can save a lot of money and taking care about not doing certain particularly stupid things with your money. There are many ways. Investing is just one of them. And if you come to the conclusion that investing is probably not the best choice for you, you could dedicate your time and effort in doing something you are more engineered to in terms of success chances. So I would like at the end of this video to invite you in asking yourself a few questions. And with the experience I'm trying to pass to you and the finding I have done in my life as an investor, ask yourself if you are really cut for it. There is no limit for a person to become successful in general. Investing is just a tool. It's just a way of doing this. It's not the only one. And maybe after you evaluated your character and personality, also on the basis of what we just went through, and together with, I hope, a lot more material, much better than mine anyway, you will come to the conclusion that, you know, you're better to go to law school or to become an engineer or to become a fantastic, successful farmer. There is no limit. You can be successful in everything you want, as long as you recognize what you're good at and what you are not good at. So this is the end of part one. Part one of many other parts I hope I will publish in the near future. And next time we're going to talk about a different aspect. As I said before, at the very beginning, there are two sides of a person. What a person is, character and personality, we discussed it this time. Next time we're going to discuss another aspect, the opposite side of the medal, what a person has and what a person should have to start on the right foot in the investing career. We are talking about time, we are talking about money, we are talking about certain basic things that without them is very, very difficult to start in the first place, and it is becoming also very risky to start if one, you know, is not having some assets, if you want, knowledge, experience, and all this kind of stuff. I hope you found this video interesting, informative. I hope it was useful to you in some ways, and if so, I would really appreciate if you let me know, because as I told you in the beginning, this has no commercial intent. I'm not making a single cent by publishing these videos. I genuinely want to help people in starting the investing career on the base of what I learned. So please let me know if you like it. If you have questions or if you have comments, please write them down and let me know what they are, because I imagine some of you might have questions, curiosities about what I mean with this or what I mean with that, or why didn't I speak about this or that, which is all very helpful for me, because I can use that material, those questions and those comments in my next video to make it more interesting, more complete, and more informative for you. So I think we're done here. I would like to thank you very much for your attention. I annoyed you for something like 1 hour and a quarter, which is quite a lot. So if you're still with me, please, thank you very much. I really appreciate it, and I wish to see you soon again. Bye now.